Hello, I hope everybody's doing well this week. We are getting into a topic of receivables, and of course, we've discussed receivables previously in this semester, but this week we're really talking about collectability and how that impacts receivables and how we record those things. And I'll give kind of an overview in this lecture, and then try to go into some depth in some subsequent lectures. But essentially, when we sell an item, what we would, I guess, ideally have happen is you sell something and you sell something in exchange for cash. And as we know, when we do that, we would record the sale as a credit, and then the cash, of course, would be debited, representing an increase in both. But for certain purchases, that's not always an option, or that's an option for very few customers. If you think about it, when you've purchased a car, or you bought a home, or you bought, large purchases, whatever that may be, quite often it's not a situation where you're paying with cash immediately. You're doing some type of credit extension, or some type of an account you're going to pay back at a later date. And businesses are no different. When you look at buying supplies, or buying whatever it may be on a receivable, it gives us the ability to then acquire the item that we need and then pay at a later date. And as business owners, we really always balance. If we were to make cash only sales, we would never have the concern of collectability, because at that point in time we would know that every sale is going to become cash. But when you do that, you limit the scope and the size of your potential market. So we're always having to balance out the opportunity to serve a wider market against the cost of collectability, and that's why we really have to monitor very carefully, not just as accountants, but as managers, what our collectible amounts are, or where our uncollectible, rather, amounts are. So for instance, if we will study this week, we'll look at aging methods, and you'll look at your receivables, and if a receivable has a due date of 30 days, well, if it's 15 days, past the time of the sale, it's not due at that point in time. So we would anticipate that the majority of people are going to make the payment by the time that it's due, and so we're not too concerned about that. Your percentage of collectability, or of uncollectability rather, may be only 1 or 2%. We anticipate on collecting most of it. But then when an item goes from 31 days, it gets beyond that date by a day, up to say 60 days. Then we start to become a little more uneasy about the likelihood of collectability. And it may be that we're anticipating that a 5% amount of this people in this group are going to be uncollectible, meaning we're only going to collect 95% of it. And then from 61 days to 90 days, then we become really uneasy. It may be that 20% of people in this category are going to be uncollectible, and then 91 days plus maybe 30 or 40% uncollectible. Why that matters is because if you think about it, when I book a sale, I'm recording the sale at the time the transaction took place. Okay. Like we mentioned before with the accrual method. And at that point in time, I'm going to book revenue at the time that revenue was earned. But then if my revenue, the offset to that, is a receivable, then what I hope to have happen is eventually the debit that I originally reported as a receivable, eventually I receive a credit for the same amount. So I clear out the receivable. And then my debit at that point in time, when the receivable is paid out, is a credit to cash. We hope to be able to convert that to cash. However, if we cannot do that, then the offsetting credit to that account receivable is going to eventually be bad debt expense. And so what we want to do is we want to have a new account called allowance for doubtful accounts, where we'll look at the total number of our receivables, and then we're going to have an estimate that's going to give us a true picture of what we anticipate our actual allowance for bad debts is going to be. And the net of those two numbers is going to give us, and give readers of our financial statements, a real picture of where we feel like our assets are. And why that matters: let's say, for instance, if I had $100,000 in receivables, and a person is looking at my balance sheet, and I have no entry, or I have no line item for allowance for doubtful accounts, they are going to logically presume that the receivables I have are going to all be collectible, that I anticipate full collection. And then at that point in time, at some point, those receivables are going to become cash. So they're going to be thinking that these are very liquid assets. But if I look at a percentage and say that in that $100,000, if I say, for instance, that maybe 10% of all of those debts I'm anticipating are going to be uncollectible. One, that's a very high percentage, and we would hope that would not be the case. But still, if they look at that, then they would reasonably assume that of the $100,000 in the asset receivable that I have, 10% of that is going to be uncollectible or has the potential to become uncollectible. And so when they're looking at my financial statements, they're going to be able to reasonably assume where I'm at in terms of my balance sheet. They're going to be able to look at that for their own understanding of where my financial picture is, and they're going to have a better sense of what's going on. Now, it may be the kind of situation where you write off something. In other words, you've got a person who's got an account that's 90 days past due, and you determine, or perhaps they tell you, I'm not going to be able to pay this. At that point in time, you say, okay, well, I've got to write this off. And so when I do that, I'm going to credit receivables for the amount, and then I'm going to debit bad debt expense because I want to record that write-off during the period in which it's earned. Now, notice I don't affect revenue again. I kept revenue in the period in which it was earned. I don't go back and reverse that. What I do instead is I record the expense at the time when it becomes uncollectible. But perhaps a person says, hey, I got my taxes back, or something happened. I had a situation where I've got money back. I would like to pay that receivable back. Then I can go through and I can basically reverse that transaction. I would then credit bad debt expense to zero out that previous entry. So if it was say for instance, it was a $500 receivable I've written off, then that receivable would get a credit at the time of the write-off. The bad debt expense would get a debit of $500, and it's going to carry a $500 balance. If the person comes in and says they can pay it, I'm going to do a reverse entry, and I'm going to credit the bad debt expense, and then I'm going to reinstate the receivable. I'm going to debit the receivable back for the $500. And then at the time when they come in to pay, then I'm going to book the entry like I normally would. It's going to be a credit to receivable and a debit to cash where they pay it all. Both of those things matter tremendously because, again, I want to have that allowance amount out there so that people understand my full picture. But then when I realize something is uncollectible, it's important for me at that point in time to write it off and realize it as an expense. Because at that point, if I leave the asset out there, sitting in this big balance of receivables, if I leave it out there knowing it's uncollectible, then I'm really not being truthful in my reporting. I know this is bad debt at this point in time. The customer has said it's bad debt, and they have said they're not going to be able to pay it. I need to then write it off. If I don't do that, then again, I'm not reporting properly. So I need to do that in a timely manner. In doing that, we adhere to one of those principles we spoke about earlier, that we're going to be truthful in our reporting. We're going to give people a realistic understanding of where we're at. Now, from a manager standpoint, if you're looking at your total percentage of bad debts, and you look at all of the aging, you look at your 30 days to 31 to 60 to 61 to 90, and so on and so forth, and say, for instance, your total bad debt has been about 4% for a number of years. If I begin to look at that and I see that trending up, maybe it's 5% or maybe it's become 6% or so on and so forth, to me, that's an indicator that I've got something wrong in a process. I may have something that I'm doing. Perhaps I'm lending to, or I'm trying to extend some of these lending terms to people that may not have the wherewithal to pay. It could be macroeconomic. We may be in a recession, and that may be some of the reasons. But as I begin to see those percentages trend upward, that to me is an indication that I need to look more closely at my business operations and determine why that's happened. Because if I've been hitting pretty consistently in terms of my estimates, why has that changed all of a sudden? So those are the kind of things we need to be thinking about critically, again, not just as accountants, but as managers, whenever we are operating within organizations. But I'll leave it there. I just wanted to kind of give us a brief update and a brief introduction of some of the stuff that we're looking at today, and just some things for you to be thinking about as you read this week and you think about the why of the chapter and the why that we do these things. Again, think about the placement on the balance sheet, placement on the statement of operations or the income statement, and how that all works. So, as always, if you have any questions, please feel free to reach out, and I'm here to help. Thank you. Have a great day.